Las Vegas home prices just hit $480,000. That's the median home price in the middle of the desert. Now here's the number that should terrify you. The median household income in Vegas, $65,000. Do the math. That means a normal family would need over 7 times their annual income just to buy a normal house. The old rule was 3 times your income. Maybe 4 if you really stretched. 7 times is fantasy land. It's impossible for regular people. And that's not the only crack forming in the desert. Homes are now sitting on the market for 55 days, up 16 days from last year. Nearly 1 in 4 sellers are slashing their asking prices. This isn't a cooling off. This isn't a correction. The cracks are starting to show, and once you see them, you cannot unsee them. Today, I'm going to show you the 7 warning signs that prove the Las Vegas housing market is heading for a breaking point. And by the end of this video, you'll understand exactly why the math no longer works. Period. Let's get into it. The median home price in Las Vegas is $480,000. The median household income is $65,000. That's a ratio of 7.4 to 1. Back in the day, the rule was 3 times your income. Maybe 4 if you stretched. 7 times? That's not a stretch. That's a fantasy. Think about what this means for a young couple, maybe a teacher and a casino worker, trying to buy their first home. At 7 times their income, they're not just priced out, they're locked out. The only people buying are either rich cash buyers coming in with suitcases of money, or families taking on debt they will never escape from. This isn't homeownership anymore. This is financial servitude. And here's the threat nobody wants to talk about. When regular working families can't afford to live in the city where they work, that's not balance. That's distortion. That's the kind of thing that eventually snaps back hard. Markets can stay irrational for a while, but reality always wins in the end. Here's a stat that tells the whole story. Homes in Vegas are now sitting on the market for 55 days. That's up 16 days from last year. That might not sound like much, but in real estate, that's huge. That's the difference between a seller's market and a buyer's market. The difference between bidding wars and price cuts. And speaking of price cuts, 23% of all listings in Vegas are dropping their prices. Nearly a quarter of sellers are basically admitting, we overshot, we got too greedy, or we're just desperate to get out. Imagine you're a homeowner who bought at the peak. Maybe you need to relocate for a job. Maybe you're going through a divorce. Maybe you just need to downsize, but your house has been sitting for 2 months. No offers, no interest, just silence. So you cut the price, then you cut it again. And suddenly you realize you're not selling a house. You're watching your equity evaporate. And here's what's really scary. The first-time buyer market has essentially died. First-time buyers are down to historic lows as a percentage of sales. Without first-time buyers, the whole market ladder breaks. Current owners can't move up because nobody's buying their starter homes. The market becomes frozen, dependent entirely on cash buyers and investors. That's not sustainable. That's not healthy. That's a market running on fumes. The California exodus that fueled Vegas's boom for the last few years, it's slowing way down. All those Bay Area tech workers who were fleeing San Francisco for Vegas, they're having second thoughts. The math isn't working anymore. Vegas prices have risen so much that the savings aren't worth the trade-offs. Plus, with remote work policies changing and companies calling people back to offices, that whole migration pattern is shifting. Picture the remote worker who moved to Vegas in 2021, sold their tiny San Francisco apartment, bought a nice house in Summerlin, thought they had it figured out. Now their company is calling them back 3 days a week. They're stuck with a Vegas mortgage and a California commute. The dream deal, it's become a trap. But wait, it gets darker. The fuel that drove Vegas's market to these heights is running out. And when your demand driver disappears, prices don't just plateau, they fall. Those California buyers weren't just customers. They were the floor under the market, and that floor is crumbling. Vegas's economy is built on 3 pillars: tourism, conventions, entertainment. All 3 are facing serious headwinds right now. Convention business hasn't fully bounced back from 2020. International tourism is still down. Sports betting is now legal in most states. So that exclusive draw Vegas had? gone. The new Formula One race was supposed to inject life into the economy, but from what locals say, it mostly just created traffic nightmares and construction headaches. Think about the dealer or the hotel housekeeper who's worked the strip for 20 years. Tips are down, hours are cut, the steady flow of high rollers, not what it used to be. These are the people who actually make Vegas function. Teachers, firefighters, nurses, casino workers. They're getting priced out of their own city. They're moving to Henderson, to North Las Vegas, commuting hours each way because they can't afford to live where they work. And then the dominoes started falling. That brain drain, that service drain, it hollows out a city, makes it less livable, less desirable, less valuable. When your city's economic foundation starts shaking, the housing market feels it first. Here's a stat that should make everyone pause. 23% of home sales in Vegas are going to investors. These are not families buying their dream home. These are corporations, hedge funds, private equity firms buying up housing stock to turn into rentals. They're treating homes like stocks, like commodities to trade. Now think about this from the investor's perspective. They bought a property expecting rents to keep climbing, but rents in Vegas, they're hitting a ceiling. People can only pay so much before they either leave, move in with family, get roommates, or move to cheaper areas. When rents stop rising while property prices remain high, that gap between what investors paid and what they can earn becomes dangerous. And just like stocks, when sentiment shifts, when the numbers stop making sense, they sell fast, without emotion, without caring about the neighborhood or the community, just pure profit calculation. That's when investors start looking for exits. And when they all head for the exit at once, it resets property values for entire neighborhoods, dragging everyone else down with them. The short-term rental market, the Airbnb market, is another domino waiting to fall. Vegas was flooded with investors buying properties to rent to tourists, but the city has been cracking down on party houses. Hotel prices are competitive again. The easy money from short-term rentals is drying up, leaving investors with properties that don't cash flow at current prices. This is the elephant in the room that nobody wants to discuss. Lake Mead is at historically low levels. Las Vegas gets 90% of its water from Lake Mead. The federal government keeps announcing new water restrictions and new tiers of cutbacks. Every tier means less water, higher costs, and more restrictions. Building new homes requires water rights. Running existing homes requires water. Imagine the retiree who moved to Vegas seeking sun and low taxes. But now, the heat is getting worse. Healthcare infrastructure is strained. The cost of living isn't that low anymore when you factor in air conditioning bills, water costs, and insurance. 120-degree days aren't rare anymore. They're normal. Air conditioning costs are exploding. Power grids are stressed. For a retiree on a fixed income, these rising costs aren't inconveniences. They're existential threats. The entire desert city model depends on water that's running out. That's not fear, that's physics. That's reality that no amount of positive thinking can change. Desert cities do not have unlimited water, and investors, banks, and insurance companies are starting to price that reality into their calculations. I keep thinking about 2007 in Vegas. Everyone said it was different. Population was growing. California money would never stop flowing. The entertainment industry was recession-proof. Then, 2008 happened. Vegas got hit harder than almost anywhere. Prices dropped 60% in some areas. Entire neighborhoods became ghost towns. Rows of empty houses with dead lawns because nobody could afford to water them. The psychology of the market has shifted. That FOMO, that fear of missing out that drove people to bid $50,000 over asking, it's gone. Replaced by fear of buying at the peak, fear of being underwater on a mortgage, fear of being stuck in a desert city with no water, paying a mortgage on a house worth less than you paid. Once that psychological shift happens, it is very hard to reverse. We are not there yet, but the setup feels familiar. The luxury market is already cracking. High-end homes are sitting longest, seeing the biggest price cuts. The rich aren't dumb. They see what's happening. They're not catching falling knives. When luxury buyers pull back, it cascades down. The move-up buyers can't sell their current homes. the whole chain freezes. New home permits are slowing. Builders are pulling back. They see what's coming. When builders who make money by building stop building, that's not because they got lazy. It's because they know the market can't absorb more inventory at these prices. Credit is tightening too. Banks are getting nervous. Higher down payments, better credit scores, more documentation. The easy money era that inflated this bubble is over. So what does all of this mean for you? If you're a buyer, patience is your best weapon right now. With 23% of listings cutting prices and homes sitting for nearly 2 months, the leverage is shifting to you. Don't rush. The market is not running away from you anymore. If you're a seller, price realistically from day one. The days of aspirational pricing and bidding wars are over. Every week your house sits on the market, you lose negotiating power. If you're an investor, run the numbers again and again. Factor in rising insurance, water costs, and the ceiling on rents. If the math doesn't work today, it won't magically work tomorrow. Here are the facts. A median price of $480,000 with a median income of $65,000 is a mathematical impossibility waiting to correct. Markets don't go up forever. Desert cities don't have unlimited water. Working families cannot pay 7 times their income for housing. These are not opinions. They are facts. And facts don't care about sentiment or hope, or what your real estate agent tells you. The Vegas housing market is at a breaking point. The only question is whether it's a slow deflation over years, or a sharp correction that happens fast. The smart money is already adjusting. Private investors are being more selective. Institutional buyers are pulling back. Builders are slowing down. Insurance companies are raising rates. Water authorities are implementing restrictions. These are not random, unconnected events. They're all signals pointing the same direction. The party's ending. The music's slowing down. Now, here's what keeps me up at night. Everything happening in Las Vegas right now, these exact same warning signs are appearing in 3 other major cities across the Southwest. Same water crisis. Same affordability math. Same investor saturation. In our next video, I'm going to expose the 3 cities that are showing the same red flags that Vegas ignored, and what it means for the entire Sunbelt housing market. Make sure you're subscribed so you don't miss it. I'll see you in the next one.